Thank you for the opportunity to come to Dublin. It's been a while since I've been here. I think the last time I was here was for the Ryder Cup, which was a great event. I'd like the session to be as interactive as possible. I'd like to keep my presentation as short as possible so that we can talk about the issues and I can hear the views of the audience, or I can do what I can to help share the knowledge that I have in this area with you. It's important whenever we talk about carbon trading. There's a lot of emphasis on carbon trading, and certainly in Europe at the moment, in the UK and other parts of the world, you hear lots and lots of talk about carbon trading, people making and losing money in the markets. That's and a lot of criticism, particularly from the NGOs at the moment, that this is bad people taking advantage of the carbon markets. It's really important when we talk about it that the system that we are part of is cap and trade. And I can't emphasize enough, and I have to emphasize all the time, that the really important part of that is not the trade bit. The trade bit is sexy, it's interesting, there's movement every day, there's things happening, there's people making and losing money. It's very exciting, very dynamic, if you like. It doesn't reduce a single ton of carbon going into the atmosphere. It's got nothing to do with it. It's all about the cap. The cap is the mechanism that produces a declining amount of carbon over the long term going into the atmosphere. Deciding what the cap should be, how the cap should be applied onto industry, who should be in, who should be out, what the rules should be around that cap, that's where all the hard work goes in, that's where all the difficult decisions are made, and that's where the entire environmental benefit is provided by the introduction of mandatory caps that create an absolute limit on the amount of emissions that industry can pump into the atmosphere. So it's all about the cap. It's a horse and cart. Without a cap, there is no trade. Trade's pointless without a cap. And I receive endless delegations through my office when they hear about the success of trading at ECX and or on ECX, and a lot of Asian governments and companies coming and saying, we want to start a carbon exchange for trading. And I say, okay, well, cap and trade 101. It's all about the cap. You can't have trade unless there's a cap. And they say, yeah, we understand that. Well, we want to start an exchange. And you go, no. It's all about the cap. If you have a cap on something, you create a commodity from it. You are creating a commodity out of it, and therefore people who are subject to the cap have risks which they need to manage over the long term. So the trade part of cap and trade, which is the bit that we're involved in, the role that we play is to support the industries who are subject to the caps to help them manage the risks associated with this new commodity which they have to have. If you are one of the 5 industries in Europe who are subject to the cap and you want to generate electricity, you have to have carbon permits. If you want to burn coal, gas or oil, you have to have a carbon permit. For every ton that you pump into the atmosphere, you need an allowance. So it's a commodity. It's no different in that sense to oil, gas or coal. It's an input into your cost of production. So when I have 2,500 protesters sleeping on the pavement outside my offices saying what bad people we are, we have to be self-critical and say we need to educate people and help them to understand that the system is about the cap and introducing a cap, and trade is just there really to support that and hopefully make industry more able to accept a steeper decline in terms of the caps. So the cap is what this mechanism is all about, and really from an interest point of view and from an environmental point of view, it's that's the interesting bit. That's really the sexy bit, is the cap. And trading is merely a consequence. So you'll hear me emphasize that all the time. You hear me whenever I speak, I have to emphasize that. clearly I am involved in the trade bit. There are people making and losing money. I'm certainly a profit-making company and aiming to make as much money as possible for my shareholders, and I'm unashamed of that. But we are not reducing carbon. We're helping those who are reducing their carbon to manage the associated risks. That's really important to say. I think I've probably said it enough. Clearly, and I think that you guys are involved in policy, you know that Europe has taken a leadership position in the world with the introduction of mandatory caps. We are the only region in the world who have introduced mandatory caps. And I think that the European Union really should be lauded for this. I mean, it's something, they came away from Kyoto in 1997 with an absolute determination to honour the obligations that we signed up to in Kyoto. And we've had a lot of hot air from Australia and New Zealand and Canada and the other developed parts of the world. We've had lots of brilliant schemes which they're going to introduce somewhere at some stage. Europe's done it. We went ahead of the Kyoto period with our Phase 1 product or project, which was much criticised. And the Phase 1 project was really important, and just to talk about that a bit, because carbon price during that Phase 1 dropped from 30 euros a tonne down to 0. It was an experimental phase. It was an aim to see how this thing was going to work. This is a completely new system. And as an experiment, I think it was a huge success because it highlighted two absolutely critical elements. One was we have to be incredibly cautious about the supply because there was an oversupply of permits in this first phase. They went along to factories and said, how much do you pump into the atmosphere? And some of the Polish power producers said, we pump 10 million tonnes a year into the... So they gave out 10 million permits, and then they found they actually only produce 1 million tonnes a year, so there was this huge oversupply of permits. So one lesson learned, we've got to be really cautious about how many permits we're issuing in the first place, so supply is critical. The other issue was that we had a finite date on Phase 1. If you had any of these certificates or allowances left at the end of Phase 1, on Phase 1 plus 1 day, they were worthless. So, if a 10 euro note in your pocket tomorrow morning is going to be worthless, at 5 to midnight I'll sell it to you for a cent because it's worthless tomorrow. And that created, there was an oversupply and a finite date. The price had to drop to 0. So Phase 1 was very, very important in setting the ground rules or improving the ground rules for Phase 2, which coincides with the Kyoto period, which we're in at the moment. And it is a better scheme as a result of that. It's not perfect. We still have imperfections, and you'll find those imperfections everywhere. But we are evolving the system on the hoof, as opposed to other countries who have been perfecting brilliant cap-and-trade schemes in the classrooms and doing nothing in reality. So I think it's something that we should be proudly promoting, that we have taken a leadership position. You'll also hear just undoubtedly people saying, well, Europe is, other countries are still going to achieve their Kyoto targets. That most of them, if they are going to achieve their Kyoto targets, is purely down to recession. It's got nothing to do with any brilliance or regulatory involvement. It's because they've stopped creating as much emissions because they're turning down the boilers and their furnaces because of the recession. So Europe will hit its Kyoto targets, whatever happens over the next 2 years through to 2012, because there is an absolute cap on the amount of emissions that can be pumped into the atmosphere. Other countries, if they are to honour their Kyoto targets, need to make sure that they stay in recession, which I'm sure they're not probably that keen to do. Important also just to note that we do allow, as Europe, 12% on average across Europe of our reductions to come from supporting the clean development mechanism, supporting projects in the developing world. That is important to recognise. Many people are critical of the offset programme. It's important to distinguish in your mind between voluntary offsets and the clean development mechanism. The clean development mechanism is incredibly rigorous, certified by the United Nations. Voluntary credits around the world trade somewhere in the order of $2 to $5 at the moment a ton, thereabouts. You can get varying qualities depending on the system that you use. UN-based credits trade at about 12 or 13 euros a ton. It's incredibly difficult, and we have project developers here who are involved in developing these things, who are probably very critical of the United Nations because they've made it so painful to get credits. But to their credit, they are maintaining the quality of the currency, and I think that the credits that are coming out of the CDM are of exceptional standard as a general rule. And clearly, as Europe, we're in the process of finalising our targets for 2020. And, you know, in terms of Copenhagen, we've put a huge amount on the table. We are committed 100% as Europe to at least a 20% reduction by 2020. If the rest of the world participates, we're offering an extra 10%. We're going to go to 30% by 2020. That is a massive, massive kicker that Europe is offering the rest of the world to get themselves to the table and get involved. So, proudly European, we are showing leadership relative to the rest of the world. Okay, just briefly a little bit about me and who we are. I run the European Climate Exchange based in London, and I'm a 100% subsidiary of a group called Climate Exchange PLC, who are listed on the London Stock Exchange with a market cap of, I don't know, 300 or 400 million. I don't know what the number is today. Originally, we started. Our founder is Dr. Richard Sandor, who was running the Chicago Climate Exchange, and he was one of the first sort of real strong proponents of market-based solutions to environmental problems. Clearly, and he built on the use of these mechanisms in the sulfur and nitrous oxide area in terms of reducing local greenhouse gases, to push the development of cap-and-trade mechanisms for environmental problems. Then when the US didn't ratify Kyoto, and frankly our original founding capital started to look a little light in our pockets, we, through some colleagues at a company called Trading Emissions, had a sort of reversal into a London-based company, which is when we formed the European Climate Exchange, because Europe was the leader in this market. And consequently, something like 95 or 96% of all carbon globally trades through my exchange in Europe. So we're in a very fortunate position. There's no brilliance to it. It's lucky positioning. We have a strong community around us. As an organisation, 5 people trading huge quantities of carbon through our exchange. The reason why I am only 5 people... Oh, back again, sorry. Is that I partner with ICE, the Intercontinental Exchange, and I use their platform and infrastructure for trading activity. ICE are, I suppose, bad guys in terms of markets. They trade one of the main trading platforms globally for oil, gas, Brent, coal. But again, remember, this is a commodity. In Europe, if you trade oil, gas, coal, and the other inputs to creating electricity, then you have to have carbon as well. So we formed a partnership where if you are an existing trader in those markets, to start trading emissions, you just have to highlight a tab on your system and you can immediately start trading. So we use all of their infrastructure, and from an ECX point of view, we do the marketing and product development and that type of stuff. In terms of products, we only trade 2 products. EUAs, the European Union allowances, and those are the products of the currency, if you like, which is the European currency, and you guys probably know about that. And then we trade CERs, the products of the Clean Development Mechanism. Importantly, I should say, we only trade secondary CERs, so only once they've become commoditized. Once they have a United Nations stamp on them, they are a currency at that point, in essence, and they can be bought and used by any European industry to offset a portion of their allowances. prior to them having that United Nations stamp, they are still project specific and they still have local characteristics, which means that they're not tradable as a product because they have specific risk associated with them. It's important when we talk about the traders, when I talk about trading in our products as well, just again to emphasize, the people who trade the products on ECX, they're not trading them because they're good people. They're not trading them because they like trees or want to hug bunnies or any of that stuff. They're not greenies who are trading on our market. They are utilities, oil producers, coal and gas manufacturers. They are heavy industry who are trading these products. And they are trading them not because they want to. This has got nothing to do with corporate social responsibility. This is simply because if they want to produce electricity, they have to trade. If they're good people, they also support voluntary projects and do all of those good things that we do. And we always describe ourselves, I'm a weekend environmentalist, but Monday to Friday I work in this business. And so it's important to emphasize that the trading activity in this market, it's not about being a greenie. It's about the need to produce electricity. So part of what we do as ECX is that we bring together different market participants with different views. We are here as a risk transference market. People with a risk, because they are now subject to this cap, and what is the price going to be, need to manage that risk. If they're building efficient plant in the future, they need to know what is the cost of carbon going to be within, how much carbon credit will they get if they build the plant more effectively. They need to lock in those prices in the long term in order to provide consumers ultimately with a consistent and fair price of electricity. So we're here for those people. That's the reason why we exist. But in order for there to be trading activity, we have to draw in lots of other people. And there's a lot of arbitrage activity, there's a lot of long-term investors, and importantly, if I was in the States, I'd be saying there are liquidity providers, because if you say speculators in the US, they want to sort of take you away and put you in front of a Senate committee. But speculators are a key part of this market. It's a risk transference market. Utilities, power companies, others, they have a risk which they want to get rid of. Who's going to take that on? Somebody who thinks they can make money from taking it on. And that's what speculators do in our market. And they're a critical part of the development of the market. That's really important to emphasize. And we're not apologetic about the fact that, yes, there are people making money and losing money in the carbon market. It doesn't impact the steepness of the reduction of the environmental objectives whatsoever. Whether they make money or lose money, it's not important. The cap is still going to be achieved because the market is in place for that reason. In terms of how the market's developed over the last few years, market's grown. This is a commodity that did not exist in 2004. There was no such thing. So it's completely new. It's going to be around for hundreds of years. It's right at the beginning. In our first year, we did 94 million tons of trade. 450 million tons in our second year, 1 billion tons in 2007, 2.8 billion tons last year. This year it'll be somewhere between 5.5 and 6 billion tons is trading through our exchange. About 20 to 25 million tons every day is trading through the exchange at the moment. So significant quantities involved. Just in terms of that, the projections, last year, global trade in carbon 2 years ago, was worth about $60 billion. Last year, $120 billion. Projections through to the future are enormous with, I think there are different projections, obviously, but I think one of the US CFTC commissioners was saying that in his estimation, and he's reasonably well read on this subject, trading in carbon credits by mid-2020s will be bigger than the oil trade globally, which is a pretty heady position. A lot of people sort of talk about it. Why does the market price change? People with new commodities, a lot of people really get confused as to why there is such volatility in the price. And it's important just to think, when you think about this not as a green product, but as a commodity, it has some unique characteristics. It has a completely inelastic supply curve. Completely inelastic. Announced in advance, you have a supply curve which is known and fixed, set by government well in advance. You know exactly how many credits there are going to be. In oil or coal or gas or other commodities, there's always a bit of elasticity in the supply, because if the price goes up, you drill new holes. If the price goes down, you cap the expensive sources of those products, so you get elasticity. So this product has a known and fixed supply curve, and that's the government's decision. Governments and scientists must decide what is the reduction we should achieve, and they announce well in advance what that reduction is going to be. We know what it is through to 2012. We're about to hear what it's going to be through to 2020. Sometime around 2015, 2016, they'll announce the next phase. So we'll always know well in advance exactly how much the supply is going to be. So the commodity is very much driven by by demand. So as we go into recession on a macro level, clearly people are turning down their furnaces, demand disappears, the price will drop, and it will drop faster than it will for other commodities, because those other commodities have some elasticity in the supply curve. So it's interesting in terms of that. Clearly, on a macro level, the political support for cap and trade is a big factor. We recently had Poland and Latvia appealed the national allocations through the European courts. The court found in their favour the price of carbon dropped by about €1.25 in 2 days, because there were fears that this would create a change somehow in the supply curve. So any sort of major political or national developments of that nature have a big impact on the price. But on a more micro level, minute by minute, day by day, oil price, gold price, gas price, European weather, those are all the factors that are driving the price minute by minute in the same way as they are driving the price of other commodities. It's also the only commodity in the world that's priced in euros. So there's a real interesting currency play on it. Between EUAs and CERs, there's also slightly different supply conditions. So there's also some interesting plays between the two products. As a commodity, it's also quite interesting, because as opposed to other commodities which you need all the time, every day you need a little bit of coal or a little bit of oil, we only have an annual true-up. So only once a year do you actually have to present your commodity for the government to tear up and throw away. So it's an interesting commodity. You only need it once a year. And there's no storage costs, and there's no degradation of it. It acts like an interest rate in many ways, although it is a commodity product. So it's a strange beast which people are starting to think about the dynamics of. In terms of the price, how does it look? I mean, it is very volatile. The volatility, if you're an options player, is somewhere just in excess of 50%, which is slightly. Oil's at about 42%, so it's slightly higher. EUA price topped out at just below €30 in July last year, when the oil price was $147 a barrel. And clearly, as recession started to bite and people were turning down their furnaces and the oil price was dropping, we dropped down to a low of about €8 a tonne in terms of EUAs. So, the price is very volatile. Today, I think it's at about $13.72 a tonne, so it's come back some way. The CER price, the green price underneath there, again, remembering that this is the Clean Development Mechanism is a fantastic mechanism which is there to support reducing carbon in the developing world where it's cheaper to do so than reducing it yourself. But as a commodity, remember that as a utility or power company, you're only doing those projects because it's cheaper than doing it yourself. You're not doing it because you're nice or because you want to help China or because you want to help India or whatever. You're doing it because it's cheaper. And it's for your shareholders as a utility, you will buy these credits up to the maximum amount that you're allowed, which is only 12% of your total, if they are cheaper. If they're more expensive, you won't. You'll do it yourself. So it's, the pricing dynamics between the two are quite interesting. Just in terms of the future of the market, where we are now, so we've only got Europe, who's got their ETS up and running, operating. Not perfect, but pretty damn good. We've got Australia, Canada, New Zealand, all in the process of rolling out schemes in theory, and whether they will or won't, who knows. We've got Japan, who with the new Democratic Party, the recent election of the new Democratic Party in Japan are very progressive now and look to be very exciting in terms of that. But the intention of Kyoto was that each of these countries or regions can develop their own scheme with its own characteristics. And it doesn't matter. They don't have to link up together. But the hope is that each of them will allow some of these CERs for a portion of their reduction. So the clean development mechanism will be the kind of glue that just keeps all of these schemes vaguely similar. They don't have to be the same. You can have your own xenophobic, nationalistic conditions to the scheme. Japan's scheme, for example, is going to be really focused on buildings and on the replacement of white goods and things like that, completely different to the European scheme. Fantastic, it doesn't matter. As long as they are going to make their commitment to Kyoto, it doesn't matter how you do it. And that's why this was felt to be so much better than a tax, because you can have all of these individual conditions. I mean, the European one that we should always point out is Europe took the 5 biggest producing industries of carbon. But remember, they missed out one. Agriculture. Agriculture, because we can't do anything about agriculture in Europe. Forget the Irish farmers, the French farmers. So, but agriculture will come somewhere down the line. Australia, New Zealand, even the US system has some involvement for agriculture. They do have it on the positive side as well as the negative side, so it's going to be interesting to see how that develops. But clearly the big swinging issue for us is the US. When are they going to come to the table? Obviously, we remain hopeful that Obama is, now that he's got his health care pretty much dealt, that this is going to be his primary focus. And we hope that his next attendance in Copenhagen will be more successful than when he arrived for the Olympic bit. But in terms of that, the other big question is obviously China and India, and when should they participate? I have to say, from my point of view, Chinese government are very progressive, very involved. We're involved in a joint venture with China and National Petroleum in Tianjin. When the Chinese government make a policy decision, it will be very quick to implementation. And they are very interested, they're engaged, they're engaging with the Americans and others. But I have to say, morally, I see no reason why they should be involved at all until the US has made their contribution. That's the scheme. We put stuff up there in the atmosphere in the first place, the vast majority of it. We need to act first, and I would be frankly disgusted if China and India started to participate before the US had shown what they need to do. In terms of climate change and moving forward, it's important as well. Mandatory cap and trade is, I believe, the system that can deliver the huge wholesale change. You're not doing it because you want to or because you're nice, you're doing it because you have to. Do you have television licenses in Ireland? Who would buy those things if it was voluntary? Nobody. But, they're mandatory. Otherwise you get a knock on the door late at night. This needs to be mandatory. We have to have mandatory cap and trade. It's hugely important. But let's not forget, we need behavioural change, we need renewable targets, we might need taxes for certain segments. There are lots of policy instruments that need to be there, but my view is clearly that mandatory cap and trade is the one that can really deliver the big numbers. From my own business's point of view, as I said, the market was worth $64 billion in 2007, $120 billion in 2008. The best guess analysts are saying about $3 trillion a year by 2020. To me, anybody involved in this industry who's involved in trading or linked to it, even if you perform averagely over the next 12 years, you should do immensely well. So I think it's important that people get involved, understand how it works, and think about the opportunity side of cap and trade. Remembering, cap and trade is not tax. There is an opportunity side. There's an opportunity to make money. There is a price on carbon. Today it's only €13.72, but for every ton of carbon that you can save, or your R&D department can save, that's $13.72 in your pocket potentially as an industrial user. If you are an innovator, a researcher, you can find a way to reduce carbon going into the atmosphere. There's a price on it now. And frankly, with a supply curve that looks like that, the price seems to be going only one way. So over time, the motivation and the desire to change should be increasing, because if you don't increase as an if you don't improve as an industry, your product is going to become more and more expensive relative to your competitors, and you will die. That's it. Let's have some questions.